For years, I was drawing support and resistance levels the way everyone else did. I'd open a chart and look for an area where the price bounced off. Then I'd draw a box and hope that the price would respect it the next time it was tested. But most of the time it didn't, of course. I'd just get chopped up and faked into garbage trades. And I kept thinking I just needed to draw more levels or make them cleaner, until I realized I was doing everything backwards. I was marking levels that I hoped would work and not the ones that actually did. Because here's the thing, the price action that we see on our chart doesn't matter at all. It's mostly noise. Candlesticks don't move the market. Volume does. So I learned how to read institutional volume. I saw where all the big players really were. And these are areas where the price literally has to react, not just might react. Once I found these levels, it was like I instantly unlocked a cheat code. The price was drawn to them with unbelievable accuracy. Now I'm able to take clean A+ trades over and over while barely lifting a finger. And the best part is, you just need to draw these levels once, then they work forever. Now in this video, I'm going to show you exactly how to find and mark these levels with extreme precision, so you can stop trying to survive the market and finally start dominating it. Support and resistance levels, the way we were taught to draw them, is surface level theory. It's basically just to draw a level where the price reacted to something before and hope that it holds again. But that's just the visible part of a much deeper game. Everyone can see these levels in candlesticks. I mean, you can probably teach an 8-year-old how to draw support and resistance levels. It just seems easy. But if you've been trading for any amount of time, you know that if something seems easy or obvious, then it's always a trap. Nothing in trading is easy or effortless at the start, or we would all just be making a ton of money. It doesn't mean that trading always needs to feel impossibly difficult and time-consuming, because it's not. It can get very simple and efficient. But we need to build the right foundation to make it that way. Let's say, for example, you want to cut down trees in a forest. You can take an axe and spend all day working to cut down these trees. Or what you can do instead is take the time to build a machine that cuts down trees. Now, instead of working all day, you just need to build the machine once. Then it becomes very simple and effective. That's the difference. Cutting down trees itself is never easy, but if you build the right foundation first, you can do it way more efficiently. And that's exactly what we're doing here. When we find and mark the right institutional levels, the market will test them over and over because it has no choice. That's where institutions are, and they need to fill their orders. So once we find our levels and set up that system, it becomes automatic. Now the real zones that actually matter are built on volume, because price can't move without real buyers and real sellers. It doesn't bounce because of a line you drew. It bounces because orders are sitting there. And here's the key. Institutional volume shows you where those orders are, where price has to react, not just where it might. Think about how the market moves. It's simple. Price keeps rising as long as buyers are willing to pay higher, and price keeps falling as long as sellers are willing to sell lower. Volume shows you exactly where those shifts happen. Every single move in the market happens because someone decided to buy or sell with size. That's what creates structure, and that's what creates the levels that price actually respects. If you can read them right, you'll know when those shifts are coming, and you'll know exactly where to enter and exit on your trades. Now the question is, how do we actually find these zones? It's simpler than you think. The first thing we're going to do is pull up our chart and add 2 volume-based indicators. The first is called the Visible Range Volume Profile, or VRVP, and you can find that by searching VRVP in the Indicators tab. Once you add it, you should get something that looks like this. Now what you want to do is go into the settings of the indicator and change the row size from 24 to 200. This will make the volume bars thinner and more precise, which is exactly what we want. And you can also change the color to gray like I do if you want in the style settings. Once you get that set up, it should look something like this. This volume profile will show you all the volume traded at each price point, and that's within the visible range of the current chart. Obviously, as you go further back in time, more volume gets added to each price point, but that doesn't concern us. We only want the relevant volume that was traded in a certain area, and this is enough information to mark out supply and demand levels accurately for this area in the future. So now that we've added our first indicator, we're going to add our second one. Go back to the Indicators tab and type in SVP. Now, SVP is the session volume profile. This shows the individual volume profile for every trading day. Go into settings and change the row size from 24 to 100. And once you do that, you should get something that looks like this. Now, it might look a little overwhelming, but it's actually pretty simple. On the VRVP, you want to look for high volume nodes. These are the volume spikes that you see on the chart, and that means there was a lot of trading activity at those specific levels. They have a lot of weight, and the price is likely to react to that point if it gets tested again. So focusing on the high volume nodes on the VRVP is especially important. And when it comes to the SVP, we want to focus on the point of control, or that black line that you see in each section. The point of control, or POC, is the single price level where the most volume was traded during a session. So on a specific day, the POC will be the highest volume bar for that session. And once again, high volume levels are important because it shows where there's a lot of participation and a lot of large positions. The market basically has to move to these points because it needs the liquidity from those many orders and participants if it wants to move around. So all we need to look for is a high volume node on the VRVP and a point of control on the SVP. When you get an alignment of these points, it's basically the market screaming at you that this is a good supply and demand level. There's a lot of volume and a lot of activity and focus at each of these levels. So here we see that we have 2 points of control in the same area, and it's aligned with a high volume node. We also see that it was rejected on both sides by the price. And that's visual proof that there are a lot of large orders there because they are able to move the price up and down very quickly. That means this is a good supply and demand level. We could mark a level here. Now this is on the S&P, so we want the zone to be 7 to 10 points wide. You don't just want to draw a single line because institutions don't enter at one point, they scale in. You also don't want to make them too wide or they won't be as precise. And you typically want to center the level around the high volume node. Now, here's the key. You don't actually need to do this with every single level. You just need a strong one like this one as an anchor point. Then you can draw the rest based on this anchor point because all markets move in certain increments. So let's say we get an upswing on the S&P that would typically be a 20 to 30 point move before it consolidates before its next move, up or down. If we get a downswing on the NASDAQ instead, let's say, we might be looking at a 50 to 70 point move. So that's the breathing pace of the market. That's how far it typically moves from checkpoint to checkpoint. And once you get your anchor point and you know where institutional volume is, you basically have the entire market mapped out. Because you know that big players there will either push the market up or down by 20 to 30 points from this level, and then they'll stop and reassess. And then they'll repeat this process at the next level and do the same thing. So once you've spotted these levels once, you know all their hiding spots. You know exactly where the price is going to get tested in the future, and you'll know exactly where to target. So what you want to do is look for a place 20 to 30 points above that has a lot of tests and rejections from the price. Here we see a lot of tests on both sides at this point, so this is where we can mark our next level. That's how you sniff them out. Once again, 7 to 10 points wide. And if we move 20 to 30 points lower from our anchor, we see the same thing. This level, which had multiple tests and rejections, the price reacts to it strongly whenever it goes there. And if we move 20 to 30 points above the upper level, same thing. We get multiple tests and rejections at the same spot. That's another strong supply and demand level right there. Now, these levels don't need to be perfect, but they do need to be properly placed. That's where our anchor point comes in. Once we have that, it makes the entire thing a whole lot easier. And once we get that done, we've built our foundation. It'll be like building a tree cutting machine, and then you can just watch it cut down trees all day. And that's it. Once you've mapped out your anchor level and extended that rhythm up and down the chart, the market just starts making sense. You're no longer reacting to every candle. You're executing from zones that actually matter, zones that institutions defend and revisit over and over again. Also, this is the foundation my students build inside my mentorship. We'll build you a custom plan based on exactly where you're stuck, fix it together on private one-on-one calls, and you'll get direct chat access to me anytime you need help, plus access to this exact level-to-level chart. If that's something you want to be part of, the link's below. And if you got value from this video, drop a like and hit subscribe, and I'll see you in the next one.